These are some of the points which we'll be discussing. For example, will RIL reverse the underperformance of 2024 in 25? It's just started warming up. What will happen to HDFC Bank? That's a big index contributor and hasn't done much. There's a big section, consumer pocket. In fact, in the entire market, consumer stocks have been languishing for reasons of their own. Is there any chance of reversal coming in? What happens to IT? What are the big factors? Is it the elections, which are partly getting baked in? What to watch out for in the union budget? All these factors, and of course the earnings momentum, is what we're going to put the spotlight on. And we have our guests also joining us. So we've got two special guests joining us now. We've got Gurmeet Chadda, who's joining us now. And along with Gurmeet, we also have Nirav Sheth, who's the CEO of Institutional Equities at Emkay. So complete circle of confidence and analysis, and of course, some global view as well from Nirav. Gentlemen, good afternoon. Thank you so much for taking time out on this show. Nirav, let me start with you. At the start of March, there was talk in the market that seasonally March turns out to be volatile because of a lot of adjustment happening in advanced tax numbers have to be, deposited. Then a lot of leverage guys do reshuffling, and usually it turns out to be a bit kind of volatile, and it did turn out. But the big factor came out that net people have a lot of gains in this fiscal. Do you think, and this is the 8th year in a row that we are seeing positive returns from the market, do you see the construct of the market as easy, as positive, even in the new fiscal, or you think the investor return expectations should be moderated in this year?
So both the questions. So to answer your first question, I'm very constructive on economy, and maybe even constructive is not the right word. I am terribly bullish on the trajectory of the economy for the next several years, as we can see today. To your second part, which is largely about should we moderate the expectations from the equity markets? Certainly, when I look at the mid and the small cap space, I am still very constructive, but I believe the gains will be far more moderate than what we've seen in the last year, because we had a stupendous run in the smaller index. I don't tend to get too perturbed about an 8th year of gain or 9th year of gains. We are in a very fortunate situation in terms of the earnings trajectory. If I'm not mistaken, my earnings have almost doubled in the last 3 years, and I'm talking about the large cap sector. So you've got solid macros in terms of the outlook on the current account deficit, rupee, interest rates, earnings, and when you got all the cylinders firing, you generally don't expect valuations to come cheap. No one gives you a right to make money in the markets. You'll have to take some level of risk. So sitting where I am today, in terms of what we can see, I would go out and say that India could end up being in a bubble territory in the next 3, 4, 5 years among the emerging market unions.
Point. You even go out to say that not only constructive, but we could head to a bubble territory as well, and for reasons, and it could get prolonged. Gurmeet, you are an equal watcher of market as well as economy and other factors. What gives you more comfort? The economy, the macro data points, or numbers of the market, of the stocks which you own?
Yeah, actually, a combination of both. So if you see, for example, we often get short-sighted by the yearly performance. It's been a great year. First of all, I think we should thank markets for a stellar year. So, I mean, even had you even taken Nifty 50, you would have made 30% last one year. You should have obviously taken mid and small cap, you would have probably made 50% plus last year. Sectoral indices like reality are more than 125%. The CPSE index is almost 100%. The PSU bank index is, I think, almost 90%. So I think the only underperformer, and look at this, that 18% 1 year return, we are calling it an underperformer, which is, let's say, FMCG and banking. I think some of it would probably reverse this year as liquidity eases and rate cut cycle starts. I think some banking performance should come back. If you see, Ajay, two things. One is, if you see the Capex to GDP ratio, we had bottomed out in FY20 in COVID. Since then, we have recovered almost 250 basis points. But since 2010, which was the last Capex cycle, we are still 500 bips off. I think we are at the beginning of a new Capex cycle. The corporate debt is at an all-time low. The banks are have the lowest NPA. And I think things are looking good. Utilization levels are above upwards of 77, 78% at an economy. Secondly, if you see earnings growth of Nifty, last 4 years, our earning growth has been 21%, which is FY20 to FY24, and Nifty is up 80%. So the market actually is in line with the earnings over a 3, 4 year period. And I don't see that 15, 18% earning growth getting challenged even this year at a broader market level, right? And I think Nifty should, at some cases, so I think return expectation, yes, you may not have a year like 23, but I think there is still some money in pockets to be made. And I keep saying this a lot of times, there's some money to be made in bonds also. Last time we spoke, the 10 year was 720. As we speak, it is 7.03. My sense is the 10-year bond would be more like 650 by the end of the next year.
Fair point. With opening comments on the table with both of you, let me go back on that argument, on that picture, which my colleagues are drawing for us. Ansh is taking a look at how 24 went by, and Anisha would join us shortly with the big factors to watch for FY25, and we'll take the discussion forward. But Ansh, let's start with you.
Actually, Nifty mid-cap, Nifty small-cap, they are registering their biggest single financial year gain in over 20 years, with Nifty gaining around 27%, having Tata Motors and Bajaj Auto as the top gainers, gaining over 130%. In top losers, we have only UPL, HUL and HDFC Bank in Nifty index. Talking about other broad indices, mid-cap and small-cap both are up by around 60-69% respectively, and around 90% of both mid-cap and small-cap stocks are in green, and with over 20% stocks delivering return of over 100%. Let's shift our focus to sectoral indices too, and all major sector indices are in green, and even they touched record high levels also in this financial year, except for Nifty IT index. Nifty Realty is the top sector gainer, gaining over 130%, and PSU is advancing for fourth consecutive financial year. Nifty Bank 2 is advancing for fourth consecutive financial year. Let's talk about market capitalization as well, and here we are seeing India's market cap of stocks in FY24 has increased by around 123 lakh crore, out of which Reliance, Bharti Airtel, TCS, LIC and Tata Motors are the biggest contributors, contributing over 13 lakh crore, which is more than 10% of the total market cap addition. So overall, this financial year is marking history as they are showing record high moves.
All right, with that was the data for FY24, but what about FY25? Anisha, some of the big factors or monitorables or parts of the market we need to keep an eye out for. What are those?
Well, it promises to be an eventful and a volatile year yet again. A lot of cues really lined up. The biggest, of course, is the election outcome, which we're expecting at the start of the month of June. But more importantly, the policy action after that towards the Viksit Bharat 2047 aim is something to watch out for. Interest rate, that had already peaked for now. But when does the reversal start is the big question. Part of the street is expecting it's going to be end of this year. That's another factor to watch out for. And of course, India becoming part of global debt indices like Bloomberg as well as JP Morgan will mean more flows for India. Earnings growth, that's been the fundamental reason why the Indian markets have been doing a lot better than the rest of the economies. But the question is, will the growth rate peter? Especially for the mid-cap and the small-cap indices, we had seen that the growth rate in FY21 to FY23 was 48% for small-cap and 31% for mid-caps. Going forward, it is expected that growth rate will peter down. Street is still expecting a 31% growth rate for the next couple of years for mid-caps, but for small-caps, it is expected to come down to almost 31% versus 48% growth that we saw over the last couple of years. And the question is whether that is factored in the prices or not. The other thing to watch out for is, of course, the IPO action. We had over 75 IPOs in the year gone by, and a bunch of those block deals and QIP. Will that momentum sustain? And talking about momentum, SIPs have already nearly touched the mark of 20,000 per month. Will it hit 30,000 per month? Because FIIs were net sellers by over 1 lakh crore rupees in the year gone by, over 14,000 crore rupees, and DIIs were supported with over 2 lakh crore worth of inflows. Will that trend really continue? But apart from that, individual things that you need to watch out for when it comes to the markets, and Nifty, of course, the frontline index, there are 3 to 4 big things to watch out for. FMCG, That was one of the sectors which was a big underperformer. It gained by only 15 to 20%. And I say only to 15 to 20% because Nifty has managed to gain almost 28% in the year gone by. This was a stark underperformer. Will things reverse? Because for the likes of ITC, etc., the good news of demerger is already behind. For Asian Paints, there's headwinds of more competition. What is there in place for FMCG to turn around is the big question to watch out for. Not just that, we're also watching out for HDFC. That stock is down 10% in FY24. Huge underperformance. Will it surprise and turn around? And remember, this individual stock contributes almost 10% to Nifty. So what are the chances that HDFC would be the big star performer in the coming year? Also, of course, about Reliance, big outperformer that is. That stock alone has managed to gain 41% in the year gone by and does not even include the demerger that happened of Jio Financial Service. What lies ahead? Has it topped already? Or there could be further triggers in terms of value unlocking that might lay ahead for the company? Those are the big questions that we need to watch out for, Ajay, because these 3 or 4 factors itself constitute almost 30 to 40% of the Nifty, and that can change the overall dynamics by a whole lot.
Great summary. Thanks for that, Tanisha. Nirav, I'd like to take that point forward. We've got good earnings growth when we see 3 to 4 year picture. But the quarter gone by saw the lowest amount of earnings surprises we've seen in several quarters. And one section of the market believe in the next 2 quarters, the top line growth rate may sober down, particularly for small cap and mid cap end of the market. What are your thoughts on this argument?
Well, first of all, when it comes to mid cap and small caps, Ajay, I will not generalize because there is very bottoms up. Secondly, even when you want to look at mid cap and small caps, trying to look at one particular quarter or even 2 quarters and trying to extrapolate in terms of what happens, over the next 2 years, I think is largely a futile exercise. Uh, uh, Markets are very forward looking, right? Sometimes the stocks will react to the order inflow, sometimes they're going to react to the margin upticks. The key thing is that there are certain templates that have been created in the market, right? So you know that B2B is picking up, you know that Capex cycle is undergoing a solid recovery. And therefore, the whole idea about doing the right kind of research is that can you preempt what are going to be structural stories and what are probably, at sort of topish in terms of their cyclical outlook. I would argue that, there are far too many ideas happening from a structural perspective. And I suspect that, when people talk about the valuations, they are missing this point. The longer you can see, the higher will be the P. It is essentially about your conviction in the long-term earning trajectory.
You have a point. A lot of stock picking actually will require to be done. So the easy basket buying point, which we've seen last 2, 3 years, may have happened, but great ideas, earnings backed ideas and specific triggers may still reward you. So you are saying that we should not generalize. Gurmeet, you work with a bunch of HNIs and that kind of investing universe, which is now spread across the country and getting stronger. And we've seen reflection of that in the SIP number hitting 20K, almost there. Do you think this run rate would continue? Not only continue, but keep on incrementally going higher. So in 12 to 18 months, we are talking about, say, 25,000 or thereabout kind of, because this end of the market has been instrumental in providing a lot of stability from FI outflows.
Absolutely. I think two trends are very clear for this new generation. I also interact with a lot of college students, fresh college pass outs, is one they're traveling for. He just has 6.5 crore passports. I think this number will grow disproportionately. And we just have about 3 crore odd unique SIP investors. And I've said this before, we have 14, 15 crore people playing Dream 11 and all that cricket and online rummy apps, right? A lot of the money is still more to the formal flows. I think the retail flows are there too. In fact, Ajay, I have not seen in my career FIS flow at a decadal low. So if you see FI holding now, it is about 63 lakh crore. On current market cap, if you take, it's about 16 and a half, 17%. This was 22, 23% pre-COVID. So there's a 6% drop in FI holding as a percentage, I'm saying. And the retail holding, which is the DI holding and retail, has gone up by the same. So you have Nifty at all-time high with FI holding 5-6% down and retail ownership and domestic ownership up. I think Indians are going to own more of equity. And best way to play this is exchanges, depositories, AMCs, CAMs, RT agents, I think all have done well. And you can probably can take a more long-term view on this, and that is one. Second, I also believe that, the 8-9% people who just invest in India, within them also, the 70-80% is still your real estate, FD and LICs of the world. So one is new investors coming in. Second is the wallet share also moving more towards equity. And I think this trend is more very, very structural, and it's likely to continue even further. In fact, this $3 billion SIP book, I remember when we used to talk about this, people used to laugh that how 1 billion will become 3 billion. You will see this $5 billion in a couple of years from now, monthly SIP run.
Very interesting. Nirav, the popular narrative now building is that India may actually follow US in terms of rate cut, and that too could be back-ended in nature in India, which means last quarter or maybe first quarter of the next, and very shallow. What are your thoughts on rate cut, and is it a factor for market performance? Because we did not see a rate hike cycle also very steep. So is it right to expect a deep rate cut cycle, and will it really impact corporate India's cost of capital coming down in a huge manner?
So that's a very good question. So, I am of the view that you don't necessarily have to have an in-sync monetary policy with what US does. Our inflation overshoot was significantly lower. So we've done very well in terms of our inflation outlook, even when the whole world was facing double-digit inflation. And I think we picked up the pace at the right point of time. I believe that what the government is trying to do, and very rightly so, is that you need to try and bring your structural inflation down to sub 4%. So that band, while it talks about, plus 2%, plus or minus 2% on 4% anchor variable, I think they want to narrow it. And I think it is very, very important because just look at it. If you look at India, the biggest problem has been the fact that you have historically run, high current account deficit, then the rupee depreciates, and then inflation comes in, and therefore rupee depreciates more. Just think of it. Oil, whether we like it or not, about 8-9 years back was still about $80-90, right? You got today oil trading at about $80-90. Yet the price of the diesel and petrol has doubled from roughly about $50 to now about $100. And it's not only petrol, diesel. You have talked about petrochemical stuff like that. So we don't appreciate, the damage that an excessive depreciation does on an economy. It completely distorts the cost structure. We are changing that. Now, to answer your question, I think what they've done is that while they've kept, the rates are stable, they have still tightened the policy while mostly running the left window in deficit. I think the first thing you will see is that they'll probably move into neutral territory as far as the left surplus is concerned. And then I suspect that once they get confidence about the outlook on inflation, we will start cutting the rates. That is a trajectory. And a big help to this would be how your rupee behaves. Just look at the last data print, right? You got trade deficit, which is roughly about $18.5 billion. Invisible surplus is $16.5 billion. You're virtually getting into this, neutralish sort of current account deficit numbers. That's a big structural positive.
Sure.
And we're not even talked about, improvement in manufacturing exports.
Very, very valid point. Gentlemen, I'd like to, take one closing comment each from you on theme or stocks to watch out for in this fiscal. I would urge you to be as specific as, your position permits you. Gurmeet, let's go with you.
We are adding 2-3 themes, and I'll give you a few names in terms of what we are tracking. One, as I said, I think finances make a comeback this year. I think HDFC and Kotak are due. Probably will be a little more easier for Kotak because the base is much less. It's 4-5 lakh crore balance sheet versus 25 lakh crore for HDFC. You just need one quarter when NIMs do slightly better and a good credit and deposit growth. I think that will, allay fears on for both the entities. I think some NBFCs have fallen because we saw Bajaj Finance recover from 6,000 levels to 7,200 today. I think it was a sitting duck. I think a lot of good NBFCs like Chola, Poonawalla has already done well. I think they're also tracking some niche names like Grow Capital, which is focused on MSME. We are tracking some microfinance and interior names like Credit Access Grameen. So this is one pocket we are very, very positive on. I think credit creation is absolutely necessary. And we'll probably have our own 500 billion and trillion dollar banks as we become a $10 trillion economy over the long run. So there is space. Second, I think this environment concerns, I think we are looking at opportunities which are there in terms of recycling content. One stock which we have recently added is Ganesha Ecosphere. As you know, 30% of the bottle has to be from recycled content by 530.
Right.
And on energy. So we're adding a lot of energy names, including Power Grid, some PSU names, and
Okay,
ancillaries.
that was a handful of names. Nirav, what about you? What to watch out for very quickly in
Well, the
25?
defining theme for us is Capex recovery. So I believe that the entire chain of capital goods and within that very clearly the green energy or thermal, right? So there's a big shortage in that entire space and it will require a hell lot of capital for that, those things to start humming again. I am completely with Gurmeet around financials. I tilt completely towards more towards PSUs where the valuations are in favor with a similar ROE and earnings profile and also infra-related NBFCs, right? So they will have a far, far bigger AUM growth. Yeah, but these two, themes stand out for us.
Very useful interaction, gentlemen. Nirav and Gurmeet, thank you so much for joining us. So that was the balance sheet FY24 throwback at the year gone by and also what to watch out for in terms of